let's say I have property taxes that month and I want to put it on my credit card to get those points, or I have a trip, right? And I want to get all those points on my credit card. So I max it out. Does that ding my credit score because I spiked it all the way to the top?
But man, that's a lot of work for a few points, man.
I know people that do that, so it's not out of balance, to have that kind of scenario.
Some people make some pretty poor decisions on credit because they just don't know, because some of those behaviors in our industry could be considered fraud. And you don't want to play in that gray area.
If you were recently denied for a mortgage, a refinance, or an equity loan like a HELOC or a HELOAN due to your credit score, this video is for you. In this episode, we're going to be reviewing some of the most viewed credit advice on YouTube through the lenses of mortgage brokers. There's a lot of information out there, but they might not all be relevant or helpful to you in your specific context. Welcome, I'm Peter, this is Jason, and we're the Clear Close, the mortgage experts that get you clear to close on your next mortgage.
So just a quick disclaimer, guys, we're not credit reporting agencies. We're not Experian, Equifax, or TransUnion. And we're definitely not a credit repair service, right, where we help people boost or fix their credit scores. But from a lender's and mortgage loan originator's perspective, we deal with a lot of credit reports and seeing what works and what doesn't. And we're going to give you some real world opinions on what we think actually could be good and also some red flags.
Yeah, and there's a good chance that you don't know who we are because 98% of you guys that watch this video aren't subscribed. So if you want us to stop introducing ourselves, please hit that subscribe button and be nice, leave a comment, give us some constructive criticism. We're always open to hearing what you guys have to say to us. And if this information might help someone you know, please share it with them. All right. So Jason, we are moving on today. I imagine that people who have gone through the funnel and have clicked on the link in our description, but they did not qualify for a HELOC because of the credit score was not high enough. Maybe they would go to YouTube, maybe they would go to Google or ChatGPT or whatever to get some sort of advice. And a lot of the advice out there is really good, especially if you go directly to like Experian or TransUnion, those websites, and you read directly from what they have to say. But some of that information could be a little bit difficult to understand. And YouTube is a great teacher. And there's a lot of creators who have put out amazing content in a very digestible way. But we want to react to it as mortgage originators, right?
Yeah, absolutely. Because there's a lot of information out there, and just because it's out there on YouTube or wherever platform you're digesting or trying to educate or learn from, it might not always be accurate, because some of those behaviors in our industry could be considered fraud. And you don't want to play in that gray area.
Yeah, or it might technically boost your credit score, but it might not be helpful to you if your credit score is below 640, which is the minimum credit score that you would need to qualify for a HELOC.
Or it's not even just a score. How much of that history is really yours, right? Because lenders aren't blind to it. We've seen different types of actions, and is that action going to really truly portray like your ability to repay a debt or your financial like what's your level of financial like experience and responsibility, right? So we'll go over that.
But before we move on, you have to know the basics of how credit agencies come up with the score. There's going to be 5 components. The majority of the weight goes to 2 items: payment history and amounts owed. 35% of your score is weighted towards payment history. 30% of your score is weighted towards amounts owed. And then 15% is weighted towards the length of credit history. And then you have 2 different ones: credit mix and new credit, which are about 10% weight each. So combined, that makes 100%. And these are the 5 categories that credit companies use to evaluate your credit score. This is a creator named John Liang. The video title is Best Day to Pay Your Credit Card Bill to Increase Your Credit Score. And we're going to link all these videos that we reference in the show notes.
Boost that even more by focusing specifically on the credit utilization front, which counts for 30% of your score. And that's what we'll talk about in the second section, which is the best date to pay off your credit card bill. Remember earlier in the video how I said the best date is the statement close date or the closing date, which is not your due date. Wait a minute. I thought we were supposed to pay everything on the due date. You absolutely are. However, and this is the hack. Remember earlier we also said credit utilization is how much of your total credit are you using relative to how much credit the bank gives you. Okay, that makes sense. But how do the credit bureaus know how much you're actually using? Well, that actually requires somebody to tell them. John's using 10%, 20%, 50%. And when they tell them, that particular date is the statement close date. So let's crystallize this with an example. Pulling up here my Chase Sapphire Reserve. I got up a $24,000 credit limit. Let's say last month I go and I charge off a bunch of things and I end up making $10,000 credit limit total purchases. I've got $10,000 and I would go ahead and pay off my credit card bill. However, take a look here. My closing date was April 7th, which means on April 7th, Chase takes a screenshot and sends it off to the credit bureau saying John has used $10,000 of his $24,000 credit limit, which is about 42% or so. You might be thinking, well, what's the big deal? On the due date, I'm just gonna go ahead and pay it off, which I absolutely am. But you see, my due date isn't until the 4th of May. So from April 7th to May 4th, the credit bureaus are saying, wow, John's using 42% of his credit. We're going to ding him. And so the smart thing for me to do is be very well aware of when my closing date is. And a closing date is typically like a 30-day window or so, in making sure that I pay off as much of my credit card bill as possible before the closing date or the statement close date, so that when Chase goes and reports to the credit bureau, it's like, oh, John only has used $1,000 of his $24,000 credit limit. Great, that is much better, and it's not gonna negatively ding him. It actually might positively impact my credit score. Hopefully that makes sense.
All right. Wow, that was really cool. So, timing when you pay your credit card bill could make a huge difference on whether or not the credit reporting agencies see the utilization as high or low.
Right. So I have clients that always say like, my score is like ping ponging like 60 to 80 points, right? Every cycle, like it goes up, it goes down. It's like a never ending battle, right? With the credit companies. I'm glad, number one, that you're monitoring your credit. But number two, it's like we need to sit back and understand why your credit's moving. And it's exactly what John's talking about. Because when you look at credit utilization, that is, I think, 30% of your credit score, according to the bureaus. So if you're maxing out a single card with a $25,000 limit like his at $24,999, your score's going to tank, because the credit bureaus show and report, or the credit card companies report to the bureaus, that you're using all of your available credit, right? And that you're technically a higher risk because you have relied heavily on that credit card. Whereas he mentions like paying before the statement due dates to bring that utilization down. So, say for example, you're responsible with your credit and you use 10,000 of that every month, but you pay off 10,000 every month. Don't let that payment or balance report at 10,000 to the bureaus. You want it to report at a lower level that you're comfortable paying, right? Like you said, you don't want to miss other payments or be late on anything else just because of that credit card balance. But if you are spending responsibly and you are using those credit cards as a tool to build credit history, then yeah, it's smart. You definitely want to pay before statement, and if you definitely don't want to let the statement close with a higher balance. And if you go to Experian's result on Google, for example, it tells you like if you have very high utilization, over 80%, you're probably going to be in this bucket, 300 to 579, right? If you're using more than half of your credit, you're going to be in the 580 to 669. And then those that are doing very well are going to be 670 to 739. They use over 35%. But look at this, like 20% of the population, right? They keep their credit card balances under 15 or 10%. And you're going to have a very good credit score, if not exceptional. So if you are in John's math, for example, 10,000 used over 25,000, what is that quick math there, Peter? You're probably going to be somewhere in the good range, right? Because you're letting your balances close at the 35% range or higher. So I'm not a credit repair specialist. I'm just using exactly whatever information that's available to you to try to understand credit. And from me, as a consumer's perspective, I know how much I'm using as a home buyer or homeowner. If I have a credit card, I know exactly what my monthly mortgage payment is, for example, and then I know exactly what I owe in my debt on my credit card if I have it, right? So, as a viewer here, if you have a $25,000 credit card limit, are you over here maxed out on that card, or are you down here keeping your utilization low? This is the very big piece, because like Experian tells you, like 30% of your credit score is built on how you're using your credit. So if you can control and make sure you're not overextending and spending beyond your means on that credit card, and making sure you're keeping the utilization low, on every single card that you use, and yeah, your score should naturally fall into this range, the 740 to the 850 range.
So, Jason, pop quiz for you.
Mhm.
If just pretend I'm your client, right? Or I'm a potential client. Let's say I have property taxes that month and I want to put it on my credit card to get those points. Or I have a what's it called? A trip, right? And I want to get all those points on my credit card. So I max it out. But my next paycheck comes in and I pay it down immediately within the next like few days of using that money. Could it get it back down to like 30%? This is all within the same monthly reporting period or like the monthly statement. So like,
Right. The statement isn't closed yet. It's within
no,
the
yeah, it's
newest
still within the
cycle that,
cycle. Yeah.
right. So,
So
okay, go
like
ahead.
let's say my statement starts on the 1st and ends on the 30th, and I did all of this between like the 15th and the 18th. Does that ding my
Yeah.
credit score because I
No.
spiked it all the way to the top?
Mhm. Because it's what John said, because credit card companies only report on the statement date. So if the statement closes with you maxed out or using $10,000 of it, then that's
Mm-hmm.
what the credit bureaus are going to look at with that information that they receive, saying Peter used 10,000 out of his $25,000 credit limit. So now he's at 30 something percent utilization, right? So, or at that percentage of utilization. Or if he, in your scenario, because you're so good with your finances, right? You put your property taxes on it, took your paycheck, and then immediately paid it back 3 days later, right? As it
Yeah.
cleared on the 18th. Your statement closing date's the 30th, and the balance owed by the time you get to the statement closing date is under 10%. So you're at $2,000 out of 2,500. Then the credit bureaus are going to see that you use less than 10%. So according to Experian's chart, right, you should have exceptional credit. But man, that's a lot of work for a few points, man.
I know people that do that, so it's not out of balance,
I know.
to have that kind of
I
scenario.
know.
Let's move on to the second video. Charlie Chang, quick ways to raise your credit score. I mean, all these videos, they're like 10, 15 minutes long, and they do have a lot of good advice. But once in a while, like within their like 5 or 6 points, there is a piece of advice that doesn't really apply to you, or I would say
Proceed with
red flag
caution,
it,
right?
right?
More,
Yeah, take
yeah,
it with
like
a
it's
grain of
like,
salt because it might not be helpful for you in your particular situation. So this is one of those examples.
Is you can build multiple lines of credit. Now that you started building credit history and you're paying these bills on time, the next focus would be to start getting multiple credit cards. You want to do this because when you increase the amount of credit cards you have, the total credit limit you have also will increase. For example, if I have one credit card with a limit of $500 and then I get another card with a limit of $1,000, you basically just upgrade and have a total credit limit of $1,500 now. Getting multiple credit cards like that can not only make it easier for you to stay within the 30% credit utilization ratio, which we will talk about later, but it will also strengthen your credit history because lenders will see that you have multiple credit cards that you're able to pay off on time. Getting more credit cards does increase your lines of credit, but that's not the only thing you can do. You should also be diversifying your loans. So you can actually help your credit by taking out auto loans, getting a mortgage, or even paying off small loans that are reported to the credit agencies. The reason why all these things helps is because if you pay off these different types of loans, you build different types of credit, which will look good on your report because it shows that multiple types of lenders trust you and that you're actually paying them off, right?
So let's talk about this one. Just to give credit to Charlie, and I want to be fair, like the rest of his video, like it has good advice, but this particular one, if I was to talk to somebody who was disqualified for a HELOC or a mortgage loan because their credit score wasn't, um, didn't meet the minimum requirement, this is not the type of advice I would give to them. Hey, why don't you go open up more trade lines, diversify your credit types so that you can increase your credit score? Like that's very dangerous advice.
Yeah, and I mean, if you put it in that context, of course, it's going to be very dangerous. Because like, if you have bad credit right now because life happens, and you're using your credit cards high, because you got to remember too, Peter, look back at what the Experian data shows, right? If you have a low FICO score or a lower FICO score, you're using a higher percentage of your credit card, so you're not trying to improve. You're in a position where you need money, right? So if you're using your credit cards, that should be the last line of defense if there is money that you're running towards to use in that regard. So you're not going to be getting another credit card, frankly, like if you had 580 FICO score. So it's like at this point, you need to figure out budgeting more than trying to hack your way to a higher credit score, because that's the lifestyle change you need to make, because there's a reason why those credit cards got run up, and there's a reason why you started with one credit card and got five. But flip side, the only time I would look at Charlie's advice here is not more so about the HELOC or anything like that, Peter. It's always going to be more towards like a new first time home buyer with virgin credit, if you want to call it that. Because like you're going to have a period, like you're going to have to prove that you have the ability to repay and that you're responsible financially. So I'm assuming his advice is more geared towards people that are new to credit.
This advice isn't for everybody, not for every situation, and that's kind of the point of our video. Is what we're reacting to, kind of helping people filter out the type of information depending on their context.
A lot of the YouTubers out there are hitting topics, in my opinion, where it's engaging or very good for new people is trying to establish credit to start getting their first auto loan or getting their first home. So it's like after that, it's like you have
Now
to be
what?
really good stewards of
Yeah.
your credit too, because it's a huge responsibility.
Okay. The next one is from a creator named Daniel Braun. In this video, I want to pinpoint what he talks about in terms of utilization and this unique part where he talks about how the reporting agencies and the mechanics around that. So let's watch this video.
My opinion, if there was a golden rule for credit utilization, which there kind of is, then it would be to keep utilization below 10%, but ideally in the low single digit range. However, it's not really such a big deal if you break that rule from time to time, and here's why. The way that most credit scoring models work is that for credit utilization and the amounts owed factor here, your credit score basically doesn't have a memory. And so what that means is that if you had a utilization of 35% from one billing period, that dropped your score, but then for the next billing period, you showed a utilization of 1%, your credit score is typically going to go right back up, and you're not going to be penalized for having a previously high utilization. I eventually learned this myself after several times where I had a higher utilization get reported 1 month, and then that dropped my score by like 20 or 30 points. But then once I got that utilization back up to a normal lower range the next month, my score just shot right back up. Now, there are some newer credit scoring models out there that are starting to take a look at trends with utilization, so I would still make it a habit to try to maintain a low utilization below 10% if you can, which is what I do. But I used to be so stressed about this stuff and so strict about it with always paying down each of my credit cards every single month to almost exactly 1% utilization to try to always optimize for this. Honestly, doing that was good for my score, but there's no need to be always doing that unless I'm really just trying to get my credit score in the best place possible before applying for a new credit card or a new loan. So again, my recommendation here is to get into the habit of keeping your credit utilization on all your credit cards in the low single digit range if you can, but also don't really stress about it too much, because if your utilization rises from time to time, that's sort of a natural thing. Now,
We're going to pause it there and react to that one tip or that one insight that credit bureaus don't really have a memory. I didn't know that if you have slightly high utilization 1 month and then next month you have very low utilization, like it ping pongs back. That's pretty cool.
But he did touch upon that it's not every single model, because there's different models out there, and depending on the type of model you're looking at, it's going to give you a different score. Like for example, like traditional conventional loan, FHA, VA, and just using Experian as an example, they look at FICO too. but then they have bank card scores for like FICO 8, FICO 9, and I think a new FICO 10. And then all of those weigh how you use credit cards or auto loans or personal loans or mortgage debt differently, right? So, and you got to remember, some of the models can look at previous levels of utilization and then see what that trend is, right? So, again, not getting too technical on it because I'm not a credit repair specialist, neither is Peter. But with all the reports, different types of reports we've have seen while helping clients, but it's definitely true. Like if you keep your credit utilization under 10%, you're going to have a really good credit score.
So Daniel also has another tip on the same video, which I thought was very pertinent, and he explains it like I think he's the best one to explain it too. So let's watch Daniel explain that part.
The next thing that I wish I knew about credit scores has to do with a factor that affects around 15% of your score, which is going to be length of credit history. And for this, I wish I knew the difference between length of credit history and credit age, because they both are going to sound very similar here, and they both impact your score under this factor, but in slightly different ways. So length of credit history is basically the amount of time that any given account on your credit report has been open. And for this, because you can't really control time, my two best pieces of advice are to start building your credit sooner rather than later. And then also never close your oldest credit card account if it's a card with no annual fee, because that oldest account is going to be helping your credit score as it gets older and older with time. One of my big mistakes was that I waited until I was 20 years old to open my first credit card, and I still have that account open today, and it's got a length of credit history of around 8.5 years, but it could be as much as 11 years if I opened it sooner. Another common mistake that I see a lot of people make here is that they open a credit card that has an annual fee as their very first credit card, and then they're just afraid to close it in the future, so they keep eating the annual fee, and it's probably not worth it anymore. There's plenty of amazing no annual fee starter credit cards, student credit cards, and other credit building cards out there that you should be looking into instead versus one with an annual fee. And I talked more about a few of these options in a previous video about how to climb the credit card ladder, so I'll go ahead and link that video down below if you want to check it out after watching this. And I'll also go ahead and link to a few of my favorite beginner credit cards down below in the description. The other big thing that gets included in the length of credit history factor of your credit score is going to be called age of credit. And this sounds similar to what we just talked about, but the main difference here with this is that with age of credit, the scoring models are going to look at how long all the accounts on your report have been opened. And then what they're going to do is calculate a single age that's the average of all those accounts. Because of this, you're going to have your oldest account battling to increase this average and keep it high as time goes on. But then also with any newer accounts you open, those obviously are going to drag down your average age of credit. For me personally, even though my oldest account is around 8.5 years old, because I'm always just opening new credit cards, my average age of credit is only a little over 3 years old, which is fine. But honestly, that's only going to keep getting better because most of my oldest accounts are no annual fee credit cards that I'm just going to keep open forever. With length of credit history and age of credit, you really just have to be patient and kind of let time do its thing, as this factor impacts your ability to achieve an 800 credit score. But the good news here is that, again, those previous two factors of payment history and amounts owed are going to account for around 65% of your credit score. So those are definitely what you want to focus on the most. Now,
So there's two factors in the age of credit. So it's like the age of your oldest account or trade line and the average age. Pretty interesting. I didn't know those two things were delineated, but apparently they are. So Jason, I'm sure you've talked to people who have they've never gotten any advice on credit, and they're like, "Oh, I'm just gonna close all my credit cards. I'm not gonna use any more credit cards." And like, what's your reaction to that?
No, 100%. I'll be like, no, don't do that. Like, you're just going to shoot yourself in the foot, because the next time you want to refinance or do something that involves a loan, or not even just a home loan, you're just hurting yourself, because now you just killed potentially what was good credit history, right? In terms of length of credit. So, no, you definitely don't. My advice is, if you have problems with using that credit card, just cut it up and throw it away and just pretend it's not there anymore. But don't close the account out. That's a definite no. Some people make some pretty poor decisions on credit because they just don't know.
This video is getting a little bit lengthy. We like to keep our videos around 20 minutes if we can, but we do have a lot more content to review. So if you guys want to see us react to the rest of it, there is going to be a part 2. I'll try to link it here when the video comes out. And remember, we are the Clear Close of mortgage experts to help you get clear to close. If you want to schedule a one-on-one consultation with us, there's a link in the description or in the show notes. Go ahead and click that. And if you're not subscribed, please consider subscribing. It really helps us out a lot. And if this information you think could be useful to a friend or a family member that is potentially needing a little bit of credit help, go ahead and share it to them. We hope you guys enjoyed, and we'll see you guys on the next one. All right. Bye-bye.